Tom, welcome to the show.
Thanks, Dan. I really appreciate the opportunity to be here.
Awesome. So, Tom, why don't you tell me a little bit who is CMG Financial?
CMG Financial is a privately owned national mortgage lender founded by our CEO and president, Christopher George, about 28 years ago. We have approximately 2,300 employees nationwide. We have three different divisions: retail, correspondent, and wholesale division. We are known for all of our what we would call vanilla products, all the products that many people use, the traditional 30-year loans and FHA and VA. We are also known for some unique products. One of the products which I'm going to talk about today is the all-in-one loan. Another product that we have is called Home Funded, which is the first crowdsourcing down payment program available to consumers in the country.
Okay.
Um, we are in the top 15 of lenders nationally and number one in the United States as a privately owned mortgage company.
Wow. That's a pretty amazing resume. So tell me, what is this all-in-one loan?
The all-in-one loan is a first lien position, 30-year draw, home equity line of credit with an integrated checking account. This concept has been available outside the United States for 3 to 4 decades. We were the first company to bring it into the United States back in 2005, and we have been offering it to consumers ever since.
Okay. So now how does this type of loan help homeowners or even some home buyers?
So first thing I want to cover is there is a little bit of a misconception with traditional mortgages. People think that just because you have a low rate, you expect to pay low interest. That's not true necessarily. Typically, mortgage loans are front loaded with interest. Generally, the amount of interest they charge over time is equal to about 50% of the principal balance that they borrow. The interest expense, despite the low interest rate, is still being charged. Mortgages are not cheap. The all-in-one loan was designed to lower the cost without depending on interest rates, but rather changing how their money is used on a daily basis. Consider the fact that most Americans will earn more money in 5 to 10 years of their employment than they owe on their mortgage. What makes merging checking account with a mortgage so practical is because it uses that money to lower their daily balance automatically. In fact, all deposits are applied towards loan principal, which makes this the only principal first mortgage available in America today. This provides an immediate benefit because mortgage interest is computed nightly on outstanding balance versus a predetermined amount or an amortization schedule like with a standard loan. Monthly, annual, and total interest expense is then reduced, and the payoff of that mortgage is accelerated. In most cases, this happens without a change to budget or lifestyle. Meanwhile, deposited funds, as well as equity in the home, remain available for regular spending 24/7 for 30 years without refinancing their loan.
That seems pretty groundbreaking. Now I'm going a little off script here, but what's the catch?
You know, in as long as we have been offering this program, Dan, that is usually the first question that many consumers ask. And you know what people don't take into consideration is mortgage loans always are front loaded. So banks collect most of the interest that you're going to pay over time, usually in the first 5 to 7 years. So when you start a mortgage and you make a payment, about $1.25 goes towards principal, the rest goes towards interest. So the concept just purely of when I make a payment on my mortgage, I pay interest first and then principal. And as I move through that mortgage and I reach somewhere around 12 to maybe 20 years, I reach a 50-50 standpoint where 50% of my payment goes towards interest, 50% towards principal, and then in the latter years, more principal than interest. The concept with the all-in-one is when I deposit funds into the account, they are applied principal first, has a significant impact on how I move the total amount of debt that I have. So it is a much better way for consumers to manage that mortgage. So, realistically, if I have this checking account and it's tied to my direct deposit from my employer, the morning that direct deposit check goes into that account, and let's say it's $5,000 on a $100,000 loan, my balance is instantly $95,000, and the interest going forward is going to be based off that lower balance. So it is totally a different concept when we consider the interest and the principal being flipped.
Okay. So can't you do the same thing with your current mortgage?
There are a lot of consumers that attempt to do the same thing. So a lot of consumers will start out saying they're going to pay additional principal and go down that path. The first time the car breaks down, the kids go to the hospital, whatever the case may be, the general trend is to stop them. So the idea behind doing it is most people don't have the discipline to maintain that for a long period of time. In addition, once I prepay that mortgage, those funds are tied up in my home. The only way that I can get back at those funds or the equity in my home is to come visit a mortgage loan officer and go through a refinance process and start the whole thing over again.
And pay money, and now you're paying more interest to the bank.
Exactly. Now, there have been certain programs that have come out over the years that really attempt to do what the all-in-one does. What they're doing is they're selling you a software program, telling you to go to your local bank like BECU and open a traditional home equity line of credit, second position. And through utilizing this software, you can advance principal on your primary. But again, those funds are locked in the primary. You can't get back at them. It's an archaic system. It's time consuming versus something like the all-in-one that's a set it and forget it, and it does everything automatically. The one of the huge features about this type of financing or this type of tool is the flexibility that it allows the consumer to have to determine how fast or how slow they choose to pay down the balance on their mortgage. What we know typically from consumers that have been using this product is doing nothing different than they do today, other than changing who is holding their mortgage, utilizing the all-in-one. They will typically pay down or pay off their home in about half the time of a traditional mortgage. So, most people would like to own their home in 15 years or 14 years or 10 years. You are in the driver's seat. You are the bank of you. So you control how fast or how slow.
So with this all-in-one, it's a combination mortgage and checking account. What are those features that come with the all-in-one?
So the all-in-one is a first position line of credit. We have partners that provide the banking side. So the banking side, the checking account, it has all the same features that you would have in your existing banking relationship. So ATM, debit, point of sale, checks, online bill pay, mobile banking, QuickBooks integration. So it does all the very same things. The only difference is when funds go into that checking account, they're instantly being swept into the line of credit and dropping the balance. When I need funds, funds are pulled from the line of credit and out through the checking account for whatever I need it for.
Okay, so I have an interesting question. If I have a personal personal checking account and a business checking account, can I link both of those?
So ideally, what's going to happen is the checking account is sponsored by one of our two partners, major Midwest banks. So you wouldn't be able to take your existing Chase account or your existing DECU and link it to the line of credit. You would have an independent checking account that specifically is for that line of credit. Now we see many people, as far as business accounts go, who, for example, have seasonal funds. So pool and spa company makes a majority of their money in the summer, but in the winter, their business slows down. So they tend to carry a significant balance in that business bank account for the slow months. Now, there's nothing that we have found that prevents them from moving those funds from their business account into this all-in-one account, as long as when they need to spend those funds, they're going back into the business account and out to the vendor.
Yeah. Ooh, that's interesting. That's really it. Talk about saving on interest rate. That's pretty cool. So I know we've got two more questions, and then we're going to have to. I know there's a lot we can talk about, but in the interest of time, how competitive is this interest rate?
So the interest rate is very competitive, but most importantly, your interest cost is lower over term. You have to ask yourself, what's more important to you? The interest rate that came on your loan or the amount of interest you pay on your loan? So for the all-in-one loan customer, the real money expense matters most. Effectively speaking, it's like getting a 30-year fixed interest rate at 2% for the right customer. So it's very competitive.
Wow. Okay. So now, who is the right customer? Because it feels like when you have a checkbook on your mortgage, a lot of people can get into trouble with that.
Sure. The profile varies depending on consumers' income and spending habits. When we're looking at consumers for potentially doing this loan and we find that they're heavy revolving credit users, they might not be the right person for something like this. So maybe we will counsel them that if they go and take care of these items and get less debt, we might be able to come back and do it again. Generally, what we look at is what are their spending habits? What are their saving habits? Do they have funds sitting in a bank account somewhere? Do they have money market? Do they have multiple accounts? Generally, we look for somebody that has a saving rate of somewhere around 10% to 15% of their net income every month.
Hmm.
So we take extra lengths to make sure that we model the all-in-one for their specific scenario. It's a lot longer sales cycle because what we're concerned with is we don't want to put somebody into the loan that it doesn't work for them in the long run.
Gotcha. Yeah, that makes good sense. So a little different qualifiers than a normal mortgage is you're looking at somebody healthy financially, which our next guest is going to be perfect for that. And as a matter of fact, the two of you need to meet up at a separate time. So thank you so much for coming on. Tom, do you have any, how do folks get a hold of you?
So they can reach me at teamrheamortgage.com or my phone number 206-484-1760.
Awesome. Thank you so much for joining us today. If you'd like to learn more about Tom Rhea and CMG Financial, visit teamrheamortgage.com or give them a call at 206-484-1760. Tom, thank you so much for coming on.
Thank you very
All
much.
right.